Are you ready to face the uncomfortable truth about where our economy is headed? And maybe more importantly, where the real opportunities might be hiding. We're diving deep into JP Morgan's 2025 mid-year outlook today, and it has this surprising core theme: comfortably uncomfortable.
Yeah, it's definitely not your typical rosy forecast, is it?
Not at all. It's a pretty stark look at how those initial high hopes for the year have, well, collided with a much rougher reality for the market.
Exactly. We've seen some swift, really unexpected policy shifts, particularly in the U.S., and dramatic changes in global trade, too.
Yeah.
It's a landscape that's caught many off guard. It's forcing businesses, investors, everyone really, to rethink their strategies.
Right, but here's the twist. Despite these significant headwinds, the sources suggest major equity markets, the U.S., Europe, Japan, could actually still reach new highs over the next year.
It sounds counterintuitive, but look at the S&P 500. It's surged almost 30% since its April lows. Quite something.
That remarkable resilience is exactly what we want to unpack for you today. Our mission here is to help you navigate these complex dynamics, show you why understanding this unique moment is so crucial for your financial planning.
Yeah, and we'll look at the specific drivers of this rougher reality.
Things like those chaotic tariff strategies and that accelerated timeline for Fed rate cuts.
It really is all about finding some clarity and maybe opportunity by getting, well, comfortably uncomfortable.
Okay, so let's really get into the prevailing market sentiment then. The outlook paints a pretty clear picture. Investors are described as skittish, and the turbulence stubbornly unpredictable. It sounds like the kind of environment where, conviction is pretty hard to come by.
It really is.
Yeah.
And what's striking is how uncertainty has just become the defining word
Everywhere.
for everyone.
Seems like it. Businesses are hesitating on big investments. Households are maybe pausing large purchases. Central banks are grappling with policy. And investors, they're struggling with asset allocation. This pervasive uncertainty really shapes every decision being made.
Which creates this fascinating disconnect, doesn't it?
How so?
Well, those initial lofty expectations for 2025, they've undeniably collided with a far rougher reality. So we seem to have solid fundamentals today.
Right. Things look okay on the surface.
But there's this deep, almost existential uncertainty about tomorrow. What's the real insight here for our listeners, beyond just, things are uncertain?
Well, I think the real insight and why that phrase comfortably uncomfortable is so vital is that most investors' aversion to this discomfort, it actually creates unique mispricings.
So it's not just about tolerating risk.
No, it's about actively seeking the kind of hidden alpha that emerges when other people pull back. Understanding this new normal isn't just about preparing for, a range of outcomes. It's about seeing the strategic advantage in a volatile environment. Okay, let's pivot then. Let's turn to the Trump 2.0 policies. The sources state pretty bluntly they delivered pain early for markets.
Yeah, that phrasing stood out.
We've definitely seen a noticeable spike in U.S. policy uncertainty and a significant collapse in both business and household confidence. Seems largely due to what the outlook calls on-again, off-again tariff announcements. It feels like the market was just caught off guard by how fast it all happened.
Absolutely. And the core concern about these tariffs, well, they spark the greatest investor unease. That's the quote.
And from an economic standpoint?
From an economic perspective, higher tariffs generally lead to slower growth, higher prices for consumers and businesses, and ultimately lower corporate profits.
So it's a direct hit on multiple fronts.
Yeah, it limits economic freedom, distorts markets, not ideal.
The numbers mentioned here are quite stark, too. Our sources estimate the U.S. effective tariff rate will settle in the mid-teens.
In teens.
For context, that's the highest level since the Smoot-Hawley era of the early 1930s.
Wow. That's not a great comparison historically.
No kidding. That period is infamous for making the Great Depression worse through protectionism. And get this, the initial Liberation Day tariffs back on April 2nd, they were apparently so severe that if they'd been sustained, they could have knocked the U.S. and likely global economies into recession.
That's a huge potential impact.
Is there any nuance in the sources about why the U.S. seems maybe more vulnerable in this trade war compared to previous ones, like the one in 2018?
There is, actually. Back in the 2018 trade war, the U.S. had a clearer size advantage over, say, individual trading partners. Today, the global nature of this current trade war, it significantly increases the downside risks for the U.S. economy. It hits supply chains, consumer costs much more broadly.
Ah, okay.
And this shift is a key reason why non-U.S. assets have actually outperformed U.S. assets recently. Global markets are reacting to the increased protectionism.
What's also really surprising, I thought, was the sequencing of these policies.
How they rolled out. Yeah. Many expected, pro-growth policies first, tax cuts, maybe deregulation.
Right, the more market-friendly stuff.
Instead, the sources point out that the least market-friendly policies, like higher tariffs, less immigration.
And that's a big drop, right? 80% decline from 2023 peaks mentioned.
Exactly. And austerity measures, particularly from this new Department of Government Efficiency, or DOGE,
DOGE, right.
which orchestrated spending cuts leading to over 275,000 layoffs, those things took effect much more quickly than anyone anticipated.
Is there any silver lining here for investors in these policy shifts?
There might be, actually. While some policies clearly created immediate friction, the deregulation of large U.S. banks is quietly delivering a positive impact. We're starting to.
Okay, also.
It's expected to free up over $200 billion in excess capital. And that capital can then be deployed, into private sector loan growth, significant share buybacks by major banks. We saw Goldman Sachs doing that, and also banking sector consolidation.
And when are these benefits expected? They're anticipated to materialize more fully in the second half of 2025, so potentially a boost to financial markets coming later this year.
Okay. Meanwhile, though, Congress is apparently contemplating a new tax bill, one that could add nearly $6 trillion to the budget deficit over the next decade.
$6 trillion. That's a staggering figure.
It really is.
Yeah.
So how does such a massive spending outlook immediately influence a major player like the Federal Reserve? Their actions will really determine how this debt gets financed, what it means for borrowing costs for everyone.
Oh, it's a direct link.
Yeah.
Absolutely. This potential for significant fiscal stimulus, alongside other factors we're seeing, it's definitely changing the Fed's calculus.
And that brings us to a major revision in J.P. Morgan's forecast for the Fed, right?
That's a big shift.
They now expect 3 25 basis point Fed rate cuts in 2025, starting as early as September. That's a significant acceleration from their earlier prediction. They initially thought maybe just one cut in December.
Right, a big change in outlook.
So why the sudden rush? What's driving this?
Well, there are several factors compelling this faster timeline. Firstly, we're seeing pretty clear signs of a weakening labor market.
Like what specifically?
Things like initial jobless claims rising. They hit 226,000 for the week ending August 2nd. And continuing claims climbed to 1.9 million. That's the highest level since November 2021.
Okay, so labor market softening. What else?
Secondly, there's just a broader economic slowdown underway. Economists have downgraded U.S. GDP growth expectations for 2025 quite a bit, from 2.3% down to a more modest 1.5%.
And then there's this other wrinkle, a new variable in the mix, President Trump's nomination of Stephen Miron to the Fed board.
Ah, yes, the potential impact there.
The sources suggest Miron's presence could increase divisions within the rate-setting committee, maybe push for a more dovish stance.
Especially given his view, apparently, that tariffs could actually help cut the federal deficit, which is a specific viewpoint.
It is. Does the data support that these kinds of political appointments could genuinely sway the Fed's traditional independence? Or is that overblown?
Well, the historical context is certainly interesting here. You look at the Fed's July 2025 decision just recently to hold rates steady. That decision saw 2 governors actually dissent in favor of a cut. And that was the first time we've seen a dual dissent like that since way back in 1993.
Wow. Okay, so that signals a growing divide within the committee itself.
Exactly. Which could indeed be, let's say, exacerbated by new appointments with strong views, and traders are definitely paying attention. They're now pricing in something like a 91.4% chance of a September rate cut. That reflects a pretty strong market belief in this shift.
So let's bring this back to you, our listener. What are the practical implications of lower rates? Beyond the obvious, like, okay, borrowing gets cheaper, savings rates might dip. How does the reason for these cuts, this weakness, the potential political influence, how should that change how you think about your financial decisions?
That's a great question. It means you need to look deeper than just the immediate cost of money, right? The drivers of these potential cuts, particularly the labor market weakness, the evolving political influences, they signal a very specific set of sector winners and losers that might not be immediately apparent.
Can you give an example?
Sure. Think about companies maybe with high debt loads. They'd benefit from cheaper borrowing versus, say, companies reliant on strong consumer discretionary spending, which might face headwinds if the economy is truly slowing down.
So it requires a more nuanced approach to your portfolio.
Exactly. much more nuanced.
Which brings us very neatly to this concept of portfolio resilience.
Yes.
In this environment of, as the source puts it, two-way risks to growth and inflation and persistent policy uncertainty, resilience is framed as absolutely critical. But what exactly is a resilient portfolio? What does that look like?
So at its core, a resilient portfolio is built with assets that have low or negative correlations to each other.
Meaning they don't all move in the same direction when things get choppy.
Precisely. They don't all go down together, hopefully. And each asset should also have an intrinsic ability to outperform cash over time. And then, collectively, they're designed to mitigate the severity of portfolio-level drawdowns. It's really about building a robust structure that can withstand shocks from different directions.
Okay. And the Outlook highlights 4 specific attractive asset choices for building this kind of resilience. Let's go through them. First up, equity-linked structured notes.
Right.
Explain those a bit. They offer higher return potential, but with narrower outcomes than, say, assets with similar volatility.
That's the idea. And crucially, they can provide income that isn't correlated to traditional fixed income. That's a key diversifier.
And the uptake is significant.
Apparently so. The report notes twice as many J.P. Morgan clients used them this year compared to 2024. So growing interest.
Okay, second asset class, hedge funds.
Yes. Now, these are expected to deliver returns and volatility maybe slightly higher than core fixed income, but again, with very little correlation.
And the sources favor specific types.
They do. They specifically mention less correlated hedge funds. Think relative value in macro strategies. These aim to capitalize on market dislocations, specific opportunities, rather than just riding the broad market waves up or down.
And is there evidence this works?
Well, there's a compelling statistic mentioned. Almost 80% of a diverse range of hedge fund composites, even randomly generated ones, outperformed a simple stock-bond mix on a risk-adjusted basis from December 2019 to August 2024. That's quite a period of volatility.
That is significant. Okay, third on the list, infrastructure.
Always an interesting one. This benefits from long-term contracts, which often embed inflation protection, very valuable right now, and generate significant income.
And what's driving the demand here?
It's driven by big, long-term secular shifts. Things like the increasing need for power generation, especially with data centers, and growing digital infrastructure demand. They've generated pretty steady low double-digit returns annually since the second quarter of 2008, according to the source.
Consistent. Okay, and the final one, gold.
Good old gold. It offers that time-tested protection against geopolitical risk and, importantly, potential dollar weakness.
And there's room for more buying.
Potentially, yes. What's notable is that many central banks, places like Saudi Arabia, Japan, China, currently hold less than 7% of their foreign reserves in gold. That suggests there's still significant room for increased allocation globally if uncertainty persists or rises.
Now, interestingly, when it comes to Bitcoin and other crypto assets, there's a clear note of skepticism in the sources regarding portfolio resilience.
Yes, a cautious tone there.
They indicate that, historically at least, these assets have made portfolios more fragile. Why? High volatility, despite sometimes having low correlations to traditional assets.
Right.
Is this seen as a permanent verdict, do you think, or just a reflection of crypto being a relatively immature asset class still finding its footing?
The outlook seems to suggest it's more about their current stage of development. Yes, they offer low correlation sometimes, but that extreme volatility currently outweighs the diversification benefit for building broad portfolio resilience, at least according to J.P. Morgan's analysis here.
Which highlights the importance of active portfolio management, or hygiene, as they call it.
Exactly. Many portfolios suffer from drift. Maybe you set up a 60% equity, 40% fixed income portfolio back in 2020. Well, due to market performance, especially strong U.S. equity returns, that might have naturally drifted closer to 75% equity, 25% fixed income today without you doing anything.
So you're taking on more risk than you intended.
Potentially, yes. And alongside that, many portfolios might be over-concentrated in U.S. dollar assets after the recent outperformance. Rebalancing becomes key.
So to combat that concentration, the sources advise on currency diversification, specifically mentioning looking at euro and Japanese yen-denominated equities.
That's right. J.P. Morgan's own long-term capital market assumptions for 2025 suggest you could potentially see 1% to 2% annual added returns for these, purely in U.S. dollar terms, over the next 10 to 15 years.
And that's primarily thanks to anticipated dollar depreciation.
That's the main driver, yes.
Speaking of the U.S. dollar, the outlook is pretty clear. The dollar is currently in a downtrend. It's lost value against every major currency so far in 2025.
Yeah, that trend, if it continues, directly impacts the returns you get from your international investments when you translate them back into dollars.
And this seems like a contradiction again. Despite investor concerns, nearly 70% of surveyed investors think the dollar is overvalued.
Right, a lot of skepticism about its current level.
The sources still assure us the dollar's status as the world's reserve currency will remain. Why are they so confident about that permanence when we're also seeing this elevated risk of an era of dollar decline? How do those two ideas fit together?
It's not really a contradiction, more a nuanced perspective. The dollar's strength as a reserve currency is deeply rooted.
In what?
Things like the sheer size and stability of the U.S. economy, its incredibly deep financial markets, strong institutions, relatively speaking, and just powerful network effects. I mean, it still accounts for 60% of global foreign exchange reserves, 85% of SWIFT settlements. These are huge structural advantages that aren't easily or quickly eroded.
Okay.
So while there's definitely an elevated risk of an era of dollar decline, meaning it might lose some value against other currencies over time, it's likely to be more of a subtle erosion, maybe a gradual shift, not a sudden collapse of its fundamental reserve status. At least that's the view here.
Okay, that makes sense. Now, while we've been focused a lot on the immediate policy shifts, the market reactions, the Fed, there's this powerful undercurrent shaping the long-term landscape, something that often gets overshadowed by the daily headlines.
And that is?
Artificial intelligence and AI. It kind of feels like no one is talking about AI anymore amidst all the tariff noise and everything else.
It's fallen off the front pages a bit.
But JP Morgan still sees profound implications here, right?
Absolutely. What's truly fascinating is JP Morgan's big belief, as they put it, in AI's long-term potential to catalyze really substantial productivity gains.
How substantial?
Well, consider this stat. Large language models can now deliver PhD-level outputs in some areas, while their costs have declined by a staggering 80% to 99%.
80 to 99% cost decline. Wow.
Yeah, that kind of cost reduction makes widespread adoption possible across countless industries in ways that just weren't feasible before.
Okay, but what about the skeptics? People worried about an AI bubble like we saw with .coms.
The sources address that directly. They point out that current AI capital expenditures and the stock valuations actually do not suggest a bubble, at least not yet.
Why not?
They highlight that so far, stock prices have risen with earnings and CapEx has not been financed with equity or debt issuance. It's being funded internally. In fact, the big cloud computing giants, the hyperscalers like Amazon and Meta, they're continuing very aggressive capital expenditures. Analysts are penciling in nearly 33% CapEx growth for them in 2025. They're still investing heavily.
Okay, so if AI is potentially so transformative, how can you, as an investor, ensure you have proper exposure to this growth, especially given, as you mentioned earlier, how many key companies are still private?
That is the crucial question. And the answer points towards private markets. Private market exposure is seen as critical for AI, precisely because only about 4,000 of nearly 100,000 investable software companies are actually public. A tiny fraction.
So that leads us directly into opportunities in private markets beyond just AI.
Exactly.
Let's talk deal-making first. Those initial hopes for a big boom right after the Trump election, they seem to have been tempered. Public market IPOs are sluggish.
Slow going.
And U.S. M&A growth expectations were downgraded significantly from an initial 25% growth forecast down to just 7%. So what does this kind of environment mean for private equity specifically?
It means the private equity ecosystem is coming into better balance, is the phrase used. Net cash flow was roughly flat in 2024 after two quite negative years in 2022 and 2023 where more money was called than distributed.
Okay, better balance. Does that create openings?
It does. It creates some unique openings. Specifically, secondaries are highlighted. That's the buying and selling of existing private equity interests.
Providing liquidity for earlier investors.
Exactly. They're seen as a compelling opportunity right now because you have aging assets in older funds and slower traditional deal-making exits like IPOs or M&A. Also, evergreen fund structures are mentioned as growing significantly.
Those are the open-ended funds.
Right. They continuously raise and deploy capital, offering more flexible, maybe easier access to private markets for certain investors. The estimate is they could grow from about 5% to maybe 20% of the entire private markets landscape in the next decade. Big potential growth.
And it all ties back to companies just staying private much longer, doesn't it?
It really does. The median age for a company going IPO is almost 14 years now. That's up from less than 11 years just a decade ago.
It's 14 years, and that stat about larger companies.
Yeah, a staggering 87% of U.S. companies with over $100 million in annual revenue are private.
87%. It truly underscores why you need some kind of private market access if you want full economic exposure.
It really does.
And surprisingly, perhaps, sports investments are highlighted in the report as a notable bright spot. Why sports?
Well, the thinking is that sports investments offer less correlated return streams.
Meaning they don't move in lockstep with traditional stock and bond markets.
Exactly. Provides diversification. And we're seeing record valuations. The Boston Celtics sale was mentioned as setting a record. Plus the success of ventures like Peyton Manning's Omaha Productions, valued at over $800 million now. It's become a compelling, if niche, area within private markets.
So the big takeaway here really seems to be that exposure to private markets, whether through secondaries, evergreen funds, or direct investments if you have access, is becoming critical to ensure proper exposure to the total economy.
Yeah, you might be missing out on a huge and growing part of the economic picture if you're only looking at public companies today.
Okay, so let's try and wrap this up. What does this all mean for you, our listener? Our deep dive today confirms that the market is indeed comfortably uncomfortable, as JT Morgan puts it. And maybe understanding, even embracing this uncertainty isn't just about mindset. It's actually a strategic advantage for navigating what's ahead.
I think that's right. And if we connect this back to the bigger picture for you, defining the intent of your capital, what is this money for? And really understanding your personal wealth plan.
Your risk capacity, your tolerance.
Exactly. Those are the most powerful ways to find clarity and confidently move toward your financial goals, pretty much no matter the market conditions. This clear intention helps you look beyond the day-to-day noise and volatility.
So, as we close, here's a final thought to leave you with, building on the source material. As these economic winds continue to shift and policy choices keep reshaping the landscape, what hidden opportunities might lie in the very sectors that typically fly under the radar? Think about utilities, maybe, meeting massive new energy demands from all these burgeoning data centers we talked about. Or perhaps essential services finding new efficiencies in an era of potential fiscal austerity.
Interesting areas to consider.
Lots to think about. We really encourage you to continue your own deep dive into what matters most for your financial future.